The modern financial industry operates at the microsecond. Institutional capital relies heavily on high-frequency trading, absolute data saturation, and algorithmic execution to find efficiencies in global markets. These mathematical models execute flawlessly until market sentiment fractures. Algorithms process numbers, but they cannot compute the sudden, irrational spikes of human panic or overconfidence. When human behavior overrides historical data, even the most sophisticated institutional systems fail. To solve for this unpredictable human element, we have to look backward. Modern finance often treats ancient Greek and Roman philosophy as a collection of decorative quotes for annual reports, rather than a functional operational tool. These classical texts actually provide a highly rigorous structural framework. They were designed specifically by ancient administrators to manage human motives, mitigate behavioral risk, and maintain institutional governance under extreme pressure. The foundation is the Roman concept of ratio and concilium, reason and judgment. Ratio is the quantitative bedrock, representing hard data and defined limits of exposure. Concilium is the human judgment required to interpret that data, test assumptions, and filter out misleading inputs. A flawless mathematical model processing bad assumptions will still destroy capital. Algorithmic precision is entirely useless if it is not guided and constrained by structured human judgment. When macroeconomic conditions shift rapidly, the immediate institutional instinct is to move fast. Managers face severe systemic pressure to execute trades and adjust capital allocations the moment volatility hits. The Roman operational principle of festina lente, make haste slowly, counters this impulse. It acts as an active structural defense mechanism against market momentum. Inserting a measured, deliberate pause into the decision loop allows the immediate noise to clear. This brief space exposes gaps in the data and mispriced risks that a rushed, pressure-driven impulse would completely miss. Reactive, fast trading is inherently fragile because it anchors on immediate sentiment. Paced, evidence-based execution builds durability by demanding verification before capital is deployed. In high-stakes institutional finance, controlled pacing and strategic patience protect the accuracy of execution far more reliably than raw speed. Classical Greek pragmatism demands ruthless observation. It explicitly rejects theoretical abstractions and hopeful projections, requiring capital allocation be guided by actual, measurable performance. Aristotle identified a core tension in capital allocation, the bifurcation between use value and exchange value. Use value is the practical, stable benefit an asset delivers, like sustained cash flow. Exchange value is highly volatile, dictated entirely by shifting market perception and sudden scarcity. Catastrophic institutional vulnerability occurs when risk models are anchored to exchange value during a crisis. If a portfolio relies heavily on temporary market conditions or inflated multiples, it will shatter when sentiment turns. True portfolio resilience requires severing these two concepts. Capital must be directed toward assets with durable use value, capable of sustaining operations through massive market contractions. While preparation is necessary, endless scenario testing and analysis paralysis erode capital growth just as severely as impulsive trading. Action must eventually be taken. The ancient phrase alia jacta est, the die is cast, marks the definitive threshold of risk commitment. It is the exact moment hesitation ends and exposure begins. Crossing this threshold requires strict prerequisites. A manager must define the specific objective, accurately measure the position size, and confirm the exact rationale for the trade before moving funds. The second that capital moves, the exposure becomes real, and stoic control becomes mandatory. Markets immediately push emotions through drawdown panic or momentum greed. Stoic practice actively builds a barrier between these immediate impulses and the original structural decision, neutralizing the desire to react. The operational rule is strict. Positions are adjusted only when the underlying data shifts. They are never altered simply because market mood has changed. By enforcing this boundary, structured risk commitment transforms volatile market trading from an unpredictable emotional gamble into a highly controlled, repeatable process. Individual cognitive discipline cannot scale. Without a bedrock of firm-wide institutional governance to enforce it, isolated rational decisions will ultimately be overwhelmed by systemic flaws. The Roman principle of pacta sunt servanda, that agreements must be kept, functions as a high-value financial asset, directly influencing an institution's long-term market access. Institutions that possess a reputation for absolute contract reliability materially lower their transaction costs. When credit crunches occur, this trust secures long-term access to capital that is denied to less reliable players. Cicero's rules on integrity require strict alignment between words, conduct, and intent. In modern finance, this translates directly to total operational transparency and accurate reporting. Utilizing hidden conditions, complex legal obfuscation, and shifting terms does not create lasting returns. Instead, it breeds deep systemic fragility into the firm's partnerships. This chart illustrates the exact outcome when counterparties begin to doubt an institution's commitments. The flat baseline of trust fractures, resulting in a severe, punitive repricing of risk and an exponential spike in the cost of capital. Transparency and contractual reliability are the ultimate risk mitigators. They act as the structural glue that secures institutional capital when macroeconomic conditions deteriorate. Ancient writers viewed steady, deliberate timing across extended horizons as the highest form of strategic strength. This reflects the maxim per aspera ad astra, through difficulties to the stars. It proves that long-term compounding is the direct result of structural consistency and rigorous allocation, rather than attempting to time chaotic market tops and bottoms. The construction of a highly resilient portfolio closely resembles the positioning of a classical Greek military phalanx. Every component holds a defined role that protects the others. This formation requires three distinct structural components: mobility, provided by liquid assets, a steadfast defense built on consistent income generators, and targeted advancement driven by growth positions. This is the complete classical decision engine. Algorithmic models are exceptional tools to process numbers, but classical discipline provides the framework required to manage human risk. By applying ratio, isolating use value, and enforcing stoic governance, modern institutions can move past reactive trading. They can engineer portfolios explicitly designed to outlast the volatility of human nature.